Welcome to AI Seller Academy. If you're an online seller, you know that whole GST return thing can be, well, a huge headache. So in the next few minutes, we're going to demystify the two most important forms out there, GSTR-1 and GSTR-3B, so you can file with total confidence. Ready? Let's dive in.
Okay, let me ask you something. Does the thought of getting one of those official-looking GST notices in your inbox just make your stomach do a flip? Yeah, you're definitely not alone. It's a massive source of stress for online sellers. And you know what the #1 reason those notices get sent out is? Mismatches in your returns.
And look, these mismatches aren't just little typos. They can trigger some pretty serious consequences. We're talking about financial penalties, your input tax credit getting blocked, which is your money, and just a mountain of stress you really don't need. But here's the good news. This is all completely avoidable. So how do you avoid it? Well, it all comes down to understanding the two main pillars of your GST compliance, GSTR-1 and GSTR-3B. I want you to think of them as two sides of the same coin. They absolutely have to tell the exact same story. Let's break down what each one actually does. All right, first up, GSTR-1. This is your sales return. Super simple. It's basically you telling the government, hey, here's a list of every single thing I sold this month. That's it. It's your declaration of sales. Then you've got GSTR-3B. This is your summary return. So if GSTR-1 is where you declare what you sold, GSTR-3B is where you settle up. This is where you calculate the final tax you owe, claim any credits you're entitled to, and actually make the payment. This is the action form where the money moves.
Okay, so let's zoom in on GSTR-1 first. You really want to think of this form as the foundation for your entire GST filing. If you get this part right, everything else gets so much easier. Let's walk through the essential rules to nail it every single time.
All right, rule number 1, and this is a big one that trips up so many sellers. You have to use the gross sales value from your marketplace reports. So if your gross sale is 4 lakh rupees, that's the number you report, period. You don't subtract commissions, you don't subtract shipping fees, nothing. The government wants to see that full top-line sale value. Next up, rule number 2. You've got to separate your business-to-business, or B2B sales, from your business-to-consumer, B2C sales. So what's the difference? A B2B sale is to a buyer who has a GST number, like an Amazon business account. A B2C sale is just to a regular customer without a GST number. These get reported in totally different sections of GSTR-1, so getting this right is absolutely crucial. Rule number 3 is all about using the correct GST rate and HSN code. Now, this might sound basic, but you'd be surprised how often people get this wrong. For example, some garments might be at 5% GST, while electronics are at 18%. If you use the wrong rate, that's a surefire way to get a notice from the tax department.
Now, what about returns? This is super important. Rule 4 is about handling them correctly using something called credit notes. Let's say you had total sales of $1,20,000, but customers returned $20,000 worth of stuff. You shouldn't have to pay tax on that full amount. You issue credit notes for those returns, and your final taxable value in GSTR-1 drops to $1 lakh. This directly saves you cash.
And for our last GSTR-1 rule, let's clear up some confusion around TCS, or tax collected at source. You'll see this deducted by the marketplace, but here's the key. It does not reduce your sale amount. So if a product sold for $1 lakh, you report $1 lakh in GSTR-1. Simple as that. You'll get that TCS money back later, but your reported sales figure has to stay at the gross amount. All right, so once your GSTR-1 is looking perfect, we can move on to the second pillar, GSTR-3B. This is where we deal with the money, paying what we owe and claiming back what we're owed. And you'll see how that accuracy in GSTR-1 really pays off here. And this brings us to what I call the golden rule of GST returns. Seriously, if you only remember one thing from this whole topic, make it this. The taxable value you declare in your GSTR-1 must be the exact same as the taxable value in your GSTR-3B. Any difference, even a small one, is a huge red flag for the tax department. Okay, rule number 7 is about claiming your input tax credit, or ITC. What is that? It's basically the GST you've already paid on your business expenses. Think about the GST on Amazon's commission or on your packaging supplies. You get to deduct this from the tax you owe, but, and this is a big but, you can only claim it for legitimate business expenses. That GST on your personal pizza order, yeah, that doesn't count. Remember that TCS we talked about? Here's where you get it back.
But there's a catch. You can only claim that credit after it actually shows up in your GSTR-2B statement. This happens once the marketplace files its own return. If you try to claim it before it's officially there, you're just setting yourself up for a mismatch notice. Rule number 9 covers a concept that can be a little tricky. It's called reverse charge mechanism, or RCM. Basically, for some services you use, like from a lawyer, for example, the rules are flipped. You, the person receiving the service, are the one who has to pay the GST directly to the government. This has to be paid in cash and declared separately in your GSTR-3B. It's a specific rule, so be on the lookout for it. And finally, a simple one but so important: file on time. The penalties for being late can really sting. For GSTR-1, the late fee is 50 rupees per day, and for GSTR-3B, you're charged interest at 18% per year on the tax you owe. That's just throwing away your hard-earned profits. Okay, we've gone through the rules. Now let's do a quick, rapid-fire round of the 5 most common mistakes. This is the danger zone where most sellers get into trouble. Think of this as your quick checklist of what not to do. First up, the biggest mistake of all: deducting commissions and fees and reporting your net sales. Don't do it. Always, always, always report the full gross sales value in your GSTR-1. Mistake number 2, the cardinal sin of GST filing: allowing your GSTR-1 and GSTR-3B sales figures to mismatch. I can't say it enough. These two numbers have to be identical, right down to the last paisa. Third, completely ignoring customer returns. If you don't use credit notes to adjust for returned items, you will end up paying tax on money you never actually kept. You're literally just giving money away to the government for no reason. And fourth, jumping the gun and claiming TCS credit before it shows up in your GSTR-2B. You have to remember, the system is all automated. If the credit isn't visible on the portal, the system will automatically flag your claim as a mismatch. It really is that simple. So let's wrap this up with your final compliance checklist. Before you hit that file button, just run through this in your head. Am I using my gross sales data? Does my GSTR-1 value perfectly match my GSTR-3B? Am I only claiming credits that are actually eligible and visible in my portal? And have I accounted for returns and any RCM? Nail these points, and you're on your way to stress-free compliance. And that's a wrap. I'll just leave you with one final question to think about. Take a hard look at your own accounting process. Is it set up to prevent these mistakes from happening automatically? Or are you just hoping for the best each month and leaving things to chance? Something to think about. Thanks for tuning in to AI's Seller Academy.